Happy New Year, ladies and gentlemen. I hope yours is off to a good start. So let's dive into our first story, which asks the question that many are pondering today, and that is it a better idea to downsize or to get a reverse mortgage? And which one is more costly or less costly? So let's dive into this column by Jamie Johnson. Jamie writes, many homeowners are surprised to find that their existing housing costs don't always go down as they age. Property taxes increase, maintenance becomes more expensive, while your retirement income is likely fixed. And that forces many older adults to ask the difficult question, is it cheaper to stay put and use a reverse mortgage or to sell the house and downsize? And let me just add that when it comes to relocation, where you decide to relocate to makes a big difference, especially if you're moving from a high cost to a low cost area. And that's a very big force multiplier for a retiree looking to stretch their dollars. Of course, the typical downsizing plan is to move from a larger home to something that's a little bit smaller and easier to manage. And on paper, that seems like an obvious way to cut expenses. The potential benefits of downsizing include lower property taxes. A lower cost home usually leads to a lower property tax bill, and smaller homes tend to cost less to heat and cool and to repair. But of course, every real estate transaction, when it's buying, purchasing, or refinancing, does come with a cost, and so that must be factored into the equation when deciding if a reverse mortgage or downsizing is the most cost-efficient strategy. First, you have your transaction costs, such as real estate commissions, closing costs, inspections. And by the way, one of the most expensive can be moving expenses, depending on just how far you're moving and how much stuff you're dragging along with you. Now, those expenses can total tens of thousands of dollars. And then higher interest rates. If you purchase a new home later in life or you take out a mortgage at today's rates, they may be significantly higher than the rate on your existing loan. So let's just stop and consider that for a moment. If someone is downsizing, and let's say they did refinance in 2020 or 2021, they're going to have to really look at the numbers and crunch them, because they may be getting a smaller home that costs less, but when you factor in the higher mortgage interest rate, they may be paying the same, or in some cases, even more. Their rising housing costs and HOA fees, or homeowners association fees, tend to increase over time, and that can add a strain to a fixed retirement income. And then once you do sell a home, you do give up the stability of home ownership and control over future housing costs, because you may be renting and the landlord will set the rent. She goes on to explain briefly how a reverse mortgage works and how you can eliminate an existing mortgage payment or even some consumer debt if you pay it off with the proceeds from the loan. You can create a buffer for your property taxes and maintenance costs with a reverse mortgage, and at the same time, you're going to preserve your home ownership. Unlike downsizing, she writes, a reverse mortgage doesn't require giving up the home or coordinating and paying for a move. The loan balance does grow over time, but repayment is deferred until the borrower sells the home, moves out permanently, or passes away. And I would add, if they don't continue to meet the terms of the loan conditions. In the end, she notes that the right choice often depends on how long one plans to stay in their home, how much equity you have, and whether stability or relocation better support your retirement goal. Well, ladies and gentlemen, HomeTap is back in the news, and it is not good news for the home equity investment company. We found a recent story posted in Housing Wire, which brings us up to date with the latest court action, and here it is. A Massachusetts judge has barred home equity contract provider HomeTap from arguing that the state regulator's previous approval or implicitly sanctioned the company's business model, and that does strengthen the state's case or the consumer protection lawsuit against HomeTap. In December 19th, the Suffolk County Superior Court Judge Deborah Squires Lee ruled that such fairness-based arguments cannot be used to block law enforcement action brought on behalf of the public. And the state of Massachusetts is making some very strong claims, such as that the products that were offered by HomeTap were not a housing option or contract, but rather an illegal reverse mortgage. The state alleges that HomeTap's flagship home equity investment product is an illegal, deceptive, oppressive, and unconscionable mortgage that violates the criminal usury statute. And those are very strong words indeed. We'll see if they can prove that out in court. Those seem a little bit more editorialized than factual statements, but we'll see what is proved out soon. Squire Lee's ruling means that HomeTap cannot argue that earlier interactions with state regulators, including meetings in which the company said it described its product, will not stop or prevent the AG from pursuing the case. In the litigation, which was filed in February of 2025, it alleges the company pervasively and systematically violated the state's consumer protection laws, including mortgage and foreclosure prevention laws, putting financially vulnerable homeowners at high risk of losing their home. We've mentioned before in our previous coverage of HomeTap that the company has said that their contracts were not debt, but yet they had to be repaid at some point in the future, and I think that is really one of the linchpins of the state of Massachusetts suit against the company. In exchange, the homeowner agrees to give HomeTap a share of their home's future value or a percentage thereof, and state officials argue those arrangements are not true investments, but rather illegal reverse mortgages. Also, there's something that's easy to overlook, and that is that HomeTap's home equity investment, it violated the law in Massachusetts in that it offered their products that the state sees now as a reverse mortgage to those under the age of 60, and that's highly problematic because the Massachusetts law, as it stands today, restricts reverse mortgage loans to those that are at least 60 years of age. So if they offered it to any homeowner under that, that would be yet another violation. Housing Wire reports that HomeTap has called the lawsuit baseless. HomeTap firmly believes in the integrity of our products and the financial flexibility they provide to Massachusetts homeowners, said the company to Housing Wire's Reverse Mortgage Daily in an earlier statement, adding, "We have pursued every possible avenue to engage in constructive dialogue with the Massachusetts Attorney General's office. Unfortunately, those efforts have not been reciprocated, and we believe they are pursuing an unfounded lawsuit predicated on a meritless claim." So there you have it, and as we had promised in earlier episodes, we'll keep you up to date as this case progresses in the state of Massachusetts. And in our last story, with the housing market and, yes, home values being one of the linchpins of reverse mortgage lending, I thought it fitting to look at Logan Mohtashami's latest forecast. That is for this year, 2026. Can you believe we're already saying that? So let's dive into what he sees developing this coming year when it comes to home values and the overall market. To put it simply, he says that the housing market has returned to normal inventory levels, near normal that is, and home price growth has cooled off, which we know very well. We're entering a year where buyers and sellers and buyers-to-be are on a much better footing, he says, than the unhealthy housing markets of 2020 to early 2022. And I would certainly agree that was a very unhealthy period when it came to the housing market as a whole, because once again, the Federal Reserve created an asset bubble. So here we are stuck with high home prices. The question is, how long will they stay? Putting it simply, housing data trends tend to improve when mortgage rates fall below 6.64% and head towards 6%, and then the data begins to fade a bit when the mortgage rates are above that threshold, especially when they're over 7%. Adding home prices are not growing out of control anymore, and we have an ample supply, so we're just like we were the last few years. Let's do the slow dance with the 10-year yield to guide where all this housing is going to be going in 2026. So let's take a quick look at that 10-year yield, and we can see that in January of 2025, it was at 4.76%, actually 4.79%, and then it dropped down in April as folks began running to treasuries. That's right after the big swathe of tariffs was announced by Trump. He called that Liberation Day when he was announcing the new tariffs. Then they went to 4.21, 4.25 in the summer. And then drop down here, we had a nice low of 4% in September of 2025, which dropped down even further in last October. But we're up a little bit, but not too much. So we're about 4.17%, 4.15%, and that is a very normative market. Now, when it comes to 2026 10-year Treasury rates, he expects them to range between 3.8 and 4.6%, and that would have mortgage rates ranging from 5.75 to 6.75%, respectively. And ladies and gentlemen, look how closely we see that the mortgage rates and the 10-year Treasuries really do track together. We see a bit of a decoupling when it comes to the summer and spring of 2022 and 2023. But now we see the cadence has returned to a more normative pattern. Mohtashami does note that if the labor market does materially improve in 2026, then we could see mortgage rates actually go up when that happens. So if we have a stronger economy, those rates tend to trend upward. Then he addresses the topic of mortgage spreads, which he notes most don't really understand. But to put it simply, the mortgage spread is the difference between the 10-year Treasury yield and the 30-year fixed-rate mortgage rate. So that is the spread that he's speaking of. Now, in 2023, that spread reached as high as 3.1%, really out of whack, but the more normative range is between 1.6 and 1.8%. His forecast for 2024 and 2025 was to see an improvement, and we certainly did in 2025. Mohtashami does expect to see mortgage spreads in the 1.8% level in 2026. He notes if mortgage rates can stay below 6.25%, then we could get an additional 237,000 existing home sales this year. The lower the rates go, the more home sales we will have. And of course, that's especially true in most markets of the country because home values are still stuck at their near record levels, which is creating an affordability crisis that continues to this day. And look at this chart of existing home sales. So we almost hit that high in October and January of 2021, and then we began to see it just fall precipitously as the mortgage rates increased, and now we're down to about par where you would see home sales in October of 1996. So we're more in a normal range when it comes to home sale volume, but it fell so precipitously because home sales were on pure steroids with low interest rates and the Fed buying up mortgage-backed securities, in fact, most of them. Now, one thing that can substantially change his forecast is what he calls the X factor of the Trump administration's proposals that are directed to housing policy. But he notes that he doesn't really worry about that much until he sees a proposal actually enacted, because there have been quite a few ideas, some quite far-reaching, that have been floated in recent months. Proposals such as 50-year mortgages or portable mortgages, and then the Fannie and Freddie IPO or initial public offering, and the National Housing Emergency Plan. So all of those can really have an impact, but that said, he doesn't take any of it seriously, as I mentioned earlier, until it's actually been put into place. He also adds if mortgage rates do climb in 2026, housing will slow and pricing will be negative in some parts of the country.